Welcome to Proficient Financial Planner YouTube channel. Financial Education and Awareness Series. Ever wondered why some investors sleep peacefully at night while others panic every time the market dips? The answer lies in one simple strategy: asset allocation. In this video, I'll explain what asset allocation is, why it's important, simple thumb rules, and how you can apply it effortlessly. Stick around till the end for a super easy investment solution. Let's get started. What is asset allocation? Asset allocation is the process of distributing your investments across different asset classes like equity, stocks, for long-term growth; debt, bonds, fixed income, for stability; gold and commodities for inflation protection; and real estate for wealth preservation. The purpose is to reduce risk and maximize returns based on your financial goals. Think of it like a cricket team. You need a mix of batsmen, bowlers, and all-rounders to win. Why is asset allocation important? Markets are unpredictable. If you put all your money in stocks, a crash can wipe out your wealth. If you put everything in fixed deposits, inflation will eat away your returns. That's why you need a balance. Asset allocation helps you manage risk. You won't lose everything in a market crash. Ensure growth. You don't miss out on returns. Achieve your goals, whether it's buying a house, retirement, or wealth creation. Let's now look at the thumb rules for asset allocation. While asset allocation depends on your age, risk appetite, and goals, here are some simple thumb rules to follow. The first one is 100 minus age rule. Your equity allocation should be 100 minus your age. So, if you are 30 years old, 70% equity, 30% debt and 20% in gold. The second one is 50-30-20 rule: 50% in equity, 30% in debt, 20% in gold and others. And finally the rule of 10, which basically encourages to keep 10% of your portfolio in gold for stability. Of course, these are just guidelines. Your personal risk tolerance plays a big role too. Asset allocation as per financial goals. For short-term goals, select debt mutual funds such as liquid, ultra-short or low-duration funds or fixed deposits. For medium-term goals between 4 to 5 years, invest in hybrid funds and corporate bonds, while for long-term goals, which are beyond 5 to 7 years, select equity and gold to beat inflation and earn inflation-beating returns. Let's now understand what is strategic asset allocation. It's an allocation which is based on your financial goals and risk profile. If the asset allocation as per goals is determined as 60% equity, 30% debt and 10% gold, then one needs to do periodic rebalancing of assets if they exceed or decrease in the set percentage. For example, with rise in equity markets, if the equity allocation increases to 70%, then one needs to sell the excess 10% in equity and rebalance it in other assets. This strategy is ideal for long-term wealth creation at lower risk. Let's now see a second type of asset allocation known as tactical asset allocation. It is more of an active strategy where, depending on market valuations, the investor maintains a certain percentage of his assets in cash or liquid assets to take advantage of market falls and subsequently sells equity or gold during bull runs to book profits and move the profits into cash. This strategy has higher risk and focuses on market timing. Practical example of asset allocation. Let's take an example. Meet Ravi, a 35-year-old IT professional. He wants to invest 10 lakhs rupees for long-term wealth creation. Based on the 100 minus age rule, he invests 65% in equity, stocks and mutual funds, 30% in debt, bonds and FDs, 5% in gold ETFs. Now, even if the stock market crashes, Ravi's portfolio won't collapse completely. He has a balanced approach that reduces risk. This chart shows how different assets have performed over the years. You will observe that each year the returns of the assets differs. Some give positive higher returns and some either give low or negative returns. This chart signifies why diversification within assets is important. Feeling overwhelmed? Don't worry. There's a super easy solution: multi-asset mutual funds. If you want to avoid the hassle of investing and managing different assets, you can directly invest in multi-asset mutual fund schemes. These funds invest in a mix of equity, debt, and gold as per a defined range. The fund manager adjusts the allocation based on market conditions and saves you the effort of rebalancing. For example, an XYZ multi-asset fund has 50 to 65% in equity, 30% in debt, 5% to 10% in gold, rate and arbitrage. You simply invest and let the experts handle the rest. Please read the offer documents of these schemes to understand the allocation percentages before selecting. Key takeaways: don't put all your eggs in one basket. Follow simple asset allocation rules. Multi-asset funds make investing effortless. Got questions? Drop them in the comments below. Like, share, and subscribe for more smart investment tips. Until next time, happy investing. Thank you for watching the video. Please like, comment, and share this video, and don't forget to subscribe.